And it seems we are on. So welcome everybody to this panel on fighting climate change, the role of ESG and impact investing. So if you've been connected to the Impact Forum in the last couple of days, I don't think you'll need convincing that climate change is a problem. And I assume Donald Trump is not connected yet. And, and most of you are probably not climate change deniers. But I do think it's important to emphasize that this is not something that will have an effect in 3 generations, but we really have to start to consider it as a clear and present danger, something that we need to address now. And the words, the first few words of an excellent book published in the last couple of years on climate change by David Wallace Wells, a book called The Uninhabitable Earth, are really, I think, summarizing that very well. He starts saying, it is worse, much worse than you think. And I do think this is an important issue that will not be addressed, as you probably heard already a couple of times about other challenges like deep poverty or health issues. It's not going to be addressed only by public money. We're going to need all the private money we can gather through this. And so we do need the corporate world, but most importantly, we do need financial investors to consider climate change, but also to invest in a way that will make it possible to reduce this threat as much as we can. And today we have a great panel to discuss these issues. And because all of them have experience and long experience on this topic, we will, I'll start introducing Miguel Nogales, who is a founding partner and co-chief investment officer at Generation Investment, a 30 billion investment manager, which was only started a little bit more than 15 years ago. So it went from few million to 30 billion very quickly and delivered outstanding return. As in the lingo, they beat the market by doing sustainable investing and are often considered a pioneer in showing the investment world that sustainable investing can be done profitably. We have Mike Caulfield with us from the Man Group. He's portfolio manager of the Man Responsible Investing European Leaders Fund and the Virgin Climate Change Fund, which I think the last one is, so both funds have been actually running for a number of years. But most importantly, I guess, the Man Group is one of the largest investment managers in the world. It's often referred to as one of the largest hedge fund in the world, but it's more than a hedge fund. But it's definitely one with the longest tradition, as it was founded in 1784, trading rum, cocoa, coffee, and sugar. So it has more than 200 years of trading experience and is now strongly committed to responsible investing. Maria Laura Tinelli from Acrux Partners. She's a director and founder of this firm specializing in impact investing. And she will bring her experience working before this at PRI for a number of years, Principle for Responsible Investing. So the probably most important, the largest association of investors on responsible investing. And she's also board member of the Global Steering Group on Impact Investment, which you've already heard quite a lot about, I think, during today and also the previous days. So she will bring her perspective also on developing this space in LATAM, which is what she's working on today. And last but not least, Pablo Valencia from Q Impact. He's an investment director at Q Impact and Q Energy. He also brings with to this panel 20 years of experience in private equity investment in renewable energy and financing. And before that, he was an investment banker. So we really are covering, from equity to private equity, from different kinds of investment styles and in different regions of the world. So bringing this together, I mean, the first question I'll ask my panelists is to, because there is a lot of skepticism sometimes around investors being able to play a positive role on climate change. Can they play a role? What has been your experience? And, what can you do? So can you bring from your experience some concrete facts that this is starting to work and more investors should be doing? Maybe I'll ask Miguel first. as a co-founder of an investment firm that actually had sustainability as its core. So and then we can sort of go from there. Thank you, Miguel.
Well, Fabrizio, thank you very much for having me here. It's great to be part of this great panel, and I hope all the participants are enjoying the sessions over the last few days. From our perspective, investors can and should do something about climate change. So first of all, they can, because shareholders are the ultimate owners of the business, and as ultimate owners of the business, they get to decide what happens with their capital, and if their capital is making the earth uninhabitable in some way, they have a say in that. I would also say that CEOs really listen to investors, perhaps more than you might expect. So that conversation that a shareholder has with a CEO or a leader of the firm goes a very long way. But perhaps more importantly, I would say investors should do something. I think there's a moral imperative here. I find myself with the following mental image in my head. I'm sitting around Christmas 2050, maybe explaining to my children, my grandchildren, that I was there 2020, I had all the information, but maybe I just couldn't get stuff to happen. I couldn't convince my peers, my partners. That's a mental image that I'm trying to avoid. I think we're all trying to avoid. There's a very long history of social involvement in capital, and that social involvement has tended to end up being right. And when it first came about, it seemed like it was niche or it was, fringe. So think about the way the Methodists did not invest in the slave trade. Think about the divestment movements in the 60s and 70s, 80s around the Vietnam War, around apartheid. And then on climate, the movement is more recent. When we started Generation in 2004, there was a small but committed community. That community has just grown, and it's grown for two reasons. The first one is that obviously the urgency of the climate crisis has risen. And the second is that the returns of a range of sustainable investing strategies have proved to be quite attractive, or at the very least not worse than what you get using the traditional structure. Just the final point from me is that the idea of climate changes and investing is typically framed as a risk, but you have to think this is a gigantic opportunity. I mean, as an investor, how many times do you get the following setup? In the case of power, mobility, even what we eat, what we wear, there needs to be an enormous transition. And that transition is going to happen fast. And that transition is going to have support, various forms of regulatory support and financial support. So as an investor and as an entrepreneur, that's a pretty amazing setup. So I just encourage everybody to think of the kind of rapid transition which we need to make, which has just started. I mean, we're at the very start of the S-curve. Just encourage everybody to consider that opportunity.
Thank you. Maybe I'll ask Mike to comment on this, because portfolio managers where, as they say, the rubber meets the road. In many ways, asset managers is already the hard part, because the asset owner side, let's say a pension fund, an endowment, deciding to go in this direction might be hard, but it's easier than to make it happen. And therefore, at the end of the day, it's portfolio managers who have to make it happen. So from your perspective, again, being portfolio manager in two of these funds, is it possible? Again, what challenges do you have in your daily work? Can you share that with us?
Absolutely, yeah. Thanks very much for having me, Fabrizio. Lovely to be part of this panel. I'd echo quite a lot of what Miguel has just said in terms of the challenges that we've faced. I've been running these two funds and dedicated ESG money for around 10 years. And when we first started, the concept of ESG as a fad or a niche product, as Miguel suggested, or the notion that the only way you can do ESG is to do charity, and therefore you have to sacrifice significant alpha in order to do it. I think all of my colleagues on this panel have proven over the years that clearly is not the case. For us, we absolutely think investors are a critical stakeholder in this entire process, along, frankly, with everyone in the general public, with policymakers, with governments, with regulators, and so on. So in formulating our investment process and integrating ESG fully into what we do, we do think, again, of ESG as this spectrum of risks and opportunities. We obviously want to invest in what you would call sustainable business models. We're a long-only fund. Any long-only fund that isn't investing in sustainable businesses, we would argue, isn't doing its job properly. But in doing that, you've got to identify, we think, those companies that are addressing the risks that they face and trying to mitigate the risks that they face. That's anything from resource efficiency in their operations, the circular economy, obviously climate change, and risks from natural disasters, supply chain threats, and so on. There's lots of different aspects to it. And it's part of our fundamental due diligence, as we think it should be across the entire spectrum of investment management. But as Miguel suggested, there's also huge opportunity. You can frame it in terms of the UN Sustainable Development Goals that I'm sure everyone's familiar with. But you're looking across the spectrum at mega trends, right? You're looking at this just energy transition that will last for years in renewables, but there's also opportunities in electric vehicles, there's opportunities in recycling, there's opportunities in innovation, in tech, in 5G, in Internet of Things, and all sorts of different aspects of the world. So we want our portfolio to be a combination, realistically, of these companies addressing the risks and the ones that are maximizing the opportunities. So there's an obvious first port of call if you're investing in equity space and renewables. Clearly any renewable operator is going to be a constituent of your portfolio. But if you think broader than that, the proliferation of wind energy actually is dependent on commodities, steel, copper, connections to the grids. If you want electric vehicles, you need cobalt, and cobalt is mined in the Congo. More than 50% of it is sourced in that region. There's obviously issues of artisanal mining, worries about child labor in those areas. If you want smartphones, you need rare earth metals. And we think of things, from an energy efficiency perspective, like LED lighting. We think about smarter control systems for buildings. We think about green building materials, green construction processes. There's all sorts of different opportunities and angles and ways that you can, to a degree, gain access to the opportunities presented by addressing climate change. And we want to invest in all of them. And at the same time, we think of our portfolio as a combination of leaders and improvers. So we do have an exclusion list in our portfolio, as a lot of ESG investors do, but we aren't prepared to shy away from investing in things like oil majors or mining companies. One of the examples would be Total in our portfolio at the moment. And we look at Total as a key player in the energy transition. They have a stated carbon neutrality target, admittedly a bit further out than we would like, and that's a topic we consistently engage with them on. But they're also investing in biofuels, they're also investing heavily in renewables, and over time they expect 40% of their business to be from electricity rather than oil or gas, which we see as very encouraging in terms of, at the very least, the trajectory. But for us, that's the point of engagement. We want to push these companies to be better and to lead with best practice. And we think that's the way that all of us as stakeholders in this change can help to create actual positive impact on the world.
It's very clear. So a clear point of agreement on not just risk, but also opportunities. And some of these opportunities you can capture also in the equity world by looking at how much perhaps different players are investing and are expected to benefit from it. Of course, point of disagreement might be that you are also investing in Total, for instance, in fossil fuel, while maybe generation is not, my understanding. So this is different approaches. You say, I invest in it, but I invest to engage and actually invest in the best player. But both of you mentioned opportunities and renewable, and that's, I think, a good side lead to Pablo, I think, because again, some of these opportunities you can capture in equity space, in large corporation, but probably a few more are in the private equity space, are probably more in the space that Pablo is working on. So maybe if you can tell us a bit more about the role of private equity in the renewable space. I think that would help get the pictures together of the different approaches. Yeah.
Fantastic. Thank you, Fabrizio. And And thank you, Bea, Xavi, Guillermo, and the whole Ship2B team for organizing this these days. It's been, again, another year fantastic. So congratulations and thank you very much for the initiative. So answering your question, Fabrizio, we think in our house, we think that as citizens, as savers, as consumers, as fathers, as executives, as investors, we have a responsibility to move things, to change things, to improve things. And more responsibility as investors, because we have the capacity to push things, to move a lot of resources, no, in the right direction. So we cannot only support companies and push the entrepreneurs over their ambitions, but we can also put in place initiatives that are much needed. No? And energy generation, for instance, in the space where we've been working for the last 15 years, there is need to build significant capacity, new capacity all across Europe to substitute the fossil generation plants that are currently taking most of the share of the electricity generations. That involves a lot of amount of money with very low risk profile, where you can get very decent return. No? That's what we've been doing. I'm coming today with two hats, with Q Energy and Q Impact. Q Energy is what we, Xavi would call a thematic investment fund, or Inversión con Impact. And Q Impact is an impact investment fund, Inversión de Impacto. So we have different approaches, and we can bring solutions in our respective mandates. No? In Q Energy, we follow regulation, we follow the mandate, and we deploy a lot of money in order to build new renewable plants. In Q Impact, we're focusing on the main pain points, no? in the critical points where we see underserved markets, and we try to push regulation to push the markets. For instance, in Spain, we are focusing where the generation is most contaminating and most polluting, which is in the most fragile ecosystems, in our islands, and is where less development is being carried out of the 100,000 megawatts. Very little is being done in the island. So we are doing a lot of development in the islands. We're also trying to push distributed solar. Still, we have very low penetration rates in Spain. We have a lot of irradiation. So we're trying to bring financial solutions that improve the marketing approach of the installers by providing users with the ability to install panels without having to make the investment and having savings from the very first day. So you can go on, and there's zillions of spaces where you can and you should invest and contribute to improve things, no? Because we have a responsibility, but also you don't have to sacrifice returns, so you don't have to increase the risk profile. Most on the contrary, no, there's significant opportunities if you can tap them.
Thank you, and I think you also moved us from a global discussion to maybe some of the more local conversation in Spain. And maybe on this topic, I'd like to ask Maria Laura maybe to comment from her perspective, because she's actually connecting now from London, but she's also based in Argentina and goes back and forth. And she had more of a PRI global role before. Now she's focused on LATAM South Cone. So maybe a little bit your perspective on how, again, what is happening in LATAM. That would be quite helpful. So how do you see this evolving over the last 5-10 years? Yeah.
Sure. Thank you, Fabrizio, and thank you to the whole team of Ship2B for inviting me to be part. This is a great panel. Yeah, the perspective is twofold. First is LATAM, depending where you look, it can be more advanced or less advanced in terms of how investors, governments, and intermediaries such as an asset manager or a firm such as Acrex, what role have they taken to push this agenda forward? So what you see in LATAM is not a straightforward region. It's not one thing, it's several. And at least it's two things. It's a group of developed countries that have taken the steps to start incorporating both regulation and concrete actions on ESG, and then on impact investment or on thematic investments, such as Mexico, Colombia, Brazil, Peru, to an extent, Chile, and then a second tier of countries that are giving the first steps. So in terms of what investors are doing, and echoing a bit of what Miguel and Mike and Pablo were saying, whenever I talk to investors, whether it is in LATAM or in my previous role at the PRI on what I do now with also at the SDG impact team at the UNDP, is I never talk about excluding, and I never talk about you just focus on the perfect examples or the perfect company that can only produce a good impact. You approach impact as a journey. You approach impact as you manage impact, because everything you do has impact. And Mike was pointing out to the example of, we all need mining, for example, to create or the extraction of metals to create a wind power generation plant. We all need batteries for mobile phones in order to operate. So what you need to understand, and what I work with investors to help them understand, is that everything they do has an impact. The important thing is that they focus on generating the least harmful impact in the decisions they make, in the strategies that they put together, in how they then implement the strategies, and how they select the companies, and how they accompany those companies in the process. They try to improve their credentials whenever they can. And they try to minimize or mitigate the impact that they have. Investors alone will not cut it, and that's what we see very clearly in LATAM. You can have very, very progressive investors or firms such as I don't know, a windmill or a solar power plant or very, very powerful initiatives. But if they're not appropriately accompanied by government regulation, by sort of proactive actions by the ecosystem as a whole, investors alone or companies alone cannot deliver on the promise. And that's one of the main differences I see between what happened in Europe, for example, and what's happening in LATAM. So where you see an ecosystem that's conducive, you see an exponential growth of, for example, a shift to renewable energy. Let's take the example of Uruguay, where more than 90% of the energy matrix of that country comes from renewables. Paraguay is another good example. And you might think these are tiny countries, tiny economies, but there's a conducive ecosystem formed by governments, formed by investors, formed by companies that are delivering, and all together can make the agenda progress. What I see in other countries is that same ecosystem has not happened for a variety of reasons. And we see in Europe, with initiatives that come both from regulators and from investors themselves, such as the PRI, but also the TCFD or the taxonomy, sustainability taxonomy in the EU, or the new Green Deal, everything put together creates the opportunities, creates the conducive ecosystem, and creates generates the opportunities for the market to move forward. So the main difference I see is that the ecosystem as a whole has not happened in every country at the same level in LATAM. The second difference that I see is that many of the good examples, or the examples of best practice in Europe or in other parts of the world, happened because there were many actors joining forces and acting together for this to happen, and that hasn't necessarily been the case in every country in LATAM. And what you see is a lot of appetite from investors, from especially private investors, private equity and family offices, and some institutional investors, depending on the country you look at. It might be banks, or it might be asset owners such as pension funds or insurance companies that are looking into this. One of the constraints they sometimes have is that they don't find a good enough or a big enough pipeline to deploy capital. And that's something that many intermediaries are working on solving, because what you see is sometimes good initiatives, but they're too small, or they're not investable enough, or not there yet. So yep, that's a view from LATAM.
So I mean, there is very interested this point about ecosystem, and I think and regulation. I'd like to get there in a moment, but maybe I'd just like to perhaps, again, our audience is going to be quite diverse. And so there might be people that are very familiar with divestment, exclusion, and engagement, and other people that might not be. So one difference that I see emerging is, Maria Lara was saying, and I think that's true even in the history of PRI responsible investing, is that the movement has grown a lot by basically saying that you can do this with a variety of different investment strategies. You don't need to only think about exclusion, not investing. And this is true today. Yet, I just like to hear, again, maybe the case for excluding, what do we mean by that? Not even, the negative screening or divestment, and why some divestment might be part of an investment strategy. And in this case, I guess, Miguel, you do have a clear exclusion criteria. So I'll ask you to comment on that, and then we can see the alternative.
Yeah, sure. Look, I think that the goal of generation is to maximize returns for our clients. So our strategy has been to avoid the companies that are in sunset industries or industries that are becoming less relevant, and then back companies that are providing solutions to the world's problems. But that's just one approach. I think divestment is slightly different to that, because divestment is when you already own the asset, you're a pension fund of some kind, you own the asset, and you go to the company and say, look, unless you change, I'm going to sell your stock. And that is quite powerful, and under certain circumstances, it's the right thing to do. But equally, the companies need shareholders. So some people, investment strategy will be consistent with them owning, oil and gas companies. And therefore, if you're going to own these companies, what you have to do is you engage with them in a very clear way. You use your proxy voting capability. You use your powers of persuasion to get them to move to a more sustainable business. So I think you've got those two models. What I don't think is acceptable is what most people have been doing for the last decade, which is just kind of owning and just sitting there doing nothing. So that middle ground is what's not acceptable. From my perspective, I think both divestment and engagement are two very valid strategies.
So I just wanted to make sure that there was clarity about also what these strategies are about. And again, engagement is basically a process through which you leverage your shares to drive change, by engaging the board of directors or even executives on specific issues. And I think the total example from Mike. So I think the other issue that was raised, I like to get there, because I think I see a number of questions as well around the topic of regulation. And there is maybe the first question is, again, there are some new regulations. So Maria Laura already said that, again, this is a big part of creating this ecosystem. Maybe can we specific, so there is one initiative or two major initiatives coming from the EU taxonomy, and of course the Green Deal, which are expected to be a bit of a game changer. Maybe anyone that wants to explain a bit more about why is this? So because the EU taxonomy is also probably one of the least self-explanatory of the EU initiatives, and that's saying a lot. But in the world of investment, again, we've been talking about this for a while. We all know people that have been contributing to it. So anyone that wants to explain, why do we think these EU initiatives will change the game, and perhaps not only in Europe? Mike, you want to get started?
Yeah, sure. I mean, it's particularly relevant for us as a European-focused fund manager, at least for my two funds. It seems clear to us that the entire concept of tackling climate change is gaining significant momentum. Obviously the Green Deal in Europe, and hopefully, fingers crossed, President-elect Biden in the US will re-sign to the Paris Agreement and will push for green-focused infrastructure stimulus. These top-down supranational style measures, combined with perhaps even a renewed focus on the UN SDGs, bearing in mind that these were goals that were meant to be achieved in 2030, and that's only 10 years away. All of these things now have sort of created this renewed momentum and energized the entire ESG anti-climate change movement. The taxonomy is interesting in the sense that it helps to classify and delineate investments. It helps with the concept of sort of reporting and data. It helps people to understand standards and to define what actually is a green investment. And we think that's a great step in the right direction. It should also lead to enhanced disclosure from fund managers, from asset managers, and also likely from companies along the TCFD, of course, and should allow us as investors slightly easier due diligence, let us filter the universe slightly better. But it's not without its risks, right? In the sense that it could potentially be accused of creating bubbles in certain asset classes, in certain sectors, in certain markets, if the passive community perhaps gravitates en masse towards certain sort of rubber-stamped equities or markets. My firm, through my colleague Jason Mitchell, who's the co-head of responsible investment, is involved in a number of working groups and steering groups around the EU taxonomy and the rules and regulations that will arise as a result of it, to try and navigate that, along with also the suggestion that it's perhaps overly green focused and should look a little more at the S and G pillars of ESG, which is a separate discussion. But thinking more broadly, perhaps on what else the EU is doing from a regulation perspective, the emissions trading scheme is a particularly interesting angle if you think about how to actually create a financial impact on companies for carbon emission externality. There's obviously a lot of debate about whether an emissions trading scheme is the right way to go. Europe has the most developed and most active version, but with the price currently around 27 euros, there's been some research that suggests it should be closer to 40 to 80 to really incentivize proper change. And obviously, if you're allowing emissions, you're arguably not cutting emissions. So there's those challenges. But then the EU is also looking at carbon border adjustments. It's also looking at carbon taxes. And these things, are obviously directly going to incentivize change from companies by financially penalizing those that are burying their heads in the sand. Just to come back very briefly to the Total example, Total is going to have the same installed base in renewables as Ørsted by 2022, and Ørsted is an ESG darling in inverted commas. Whereas if you look at something like Exxon in the US, perhaps catalyzed by President Trump emboldening the oil community, they're actually talking about increasing their emissions by mid-teens percentage between 2017 and 2025. By an amount almost the same as the emissions of the whole country of Kenya, if you believe a leak to Bloomberg Finance recently. So that just shows you how regulation in a specific region and how focus and attention from an investor community and the general public can really catalyze a proper change from these companies involved in the energy transition.
And is this going to be just Europe? I mean, is this going to help Maria Laura in LATAM? Is that like something that people are looking at, perhaps?
Definitely, from where I'm sitting, definitely, and especially larger institutions or asset managers, because the financial system and sector is not it's not constrained to one region. So whenever a GP or whenever a bank or whatever financial institution is either fundraising or trading with Europe or with locations where regulation or regulations and requirements such as the ones posed by the EU taxonomy and others are mandated, then it filters down. So the cascading effect, it has a positive effect on countries that are far away from where that regulation was issued, so long as where the regulation is issued or where that principle or standard comes from sits at the center of the discussion. So the best example is what happened with the PRI and with the ESG conversation. The reason why it was widely adopted is because they went to the center, they went to the asset owners of the world, and from there it cascaded down not only to asset managers, but also to service providers and to regions in the world where those asset owners were far removed. So the same is happening, and we're beginning to see how TCFD and the EU taxonomy and other regulations that are maybe passed in the EU, which is sort of the hub for many of these more proactive or progressive regulations to be issued, filters all the way down to a country such as Brazil or Argentina or Chile. And you see it in the way that the exclusion list, or the way that Banco Galicia in Argentina reports on which standards it chooses to adopt and why it chooses to adopt those standards, even though in that particular location or jurisdiction where it operates, those things are not mandated. So definitely it has an effect. There is a massive need and a massive demand from the financial sector itself for better accountability of who's doing what and how. I think that even if the demand before came from regulators, there's been so much greenwashing and rainbow washing over the recent years, I would say over the last decade, as Miguel was mentioning. It's not good enough to just sit and let the others do it. There's going to be less and less room for investors that are portraying something that they're not doing, and there's more stringent accountability, both standards and tools, in order to demonstrate that. The EU taxonomy is one of them, but we also have the SDG standards that are coming into place as from next year onwards, so the final version of them. You have the IFC principles, you have the impact weighted financial accounts. So you have many initiatives, both standard setting, regulation, and tools to implement it that are pushing in the same direction. And it definitely filters down to emerging markets.
And I think, again, there is actually, this addressed one of the questions that we had. Miguel, you want to comment on this?
I just wanted to just add very briefly. I think, I mean, in the sustainability industry, we're actually terrible at coming up with new acronyms, and there's so many of them, even I get lost with them. But the bottom line is this, that I think the era of greenwashing is coming to an abrupt end, because through regulations like taxonomy, but also IFRS, which is the accounting standard, is working on basically bringing these responsibilities into the CFO's office. So basically the point where you could just kind of say, get the hippies off my back, just come up with a nice report with pictures of nice trees, and then we're doing something, is really over. And I think that's a good thing.
I want to take one question from the audience, or perhaps two if we have time. There's one that from Nicolas Priu, which I think it's a provocative, because it basically says, if ESG and impact investing has grown exponentially for the last 10 years, and so have CO2 emissions. So if you map them on the same map, it's fair. I mean, it's a fact. Again, I think it's an actual fact. While we know they should decrease by 70% per year to meet the Paris Agreement. So in the overall aggregate, I mean, at the end of the day, I guess this question is about, we have not done enough. So what can we do to get at full speed? So we need to go faster. Because frankly, what we have seen so far is clearly not enough. So any answer to this? So is it fair? Is it too tough? Or, yeah, Mike, go ahead.
Yeah, no, I mean, I think it's absolutely fair. I think it speaks to the fact that the stakeholders of climate change are everybody, right? It's everybody from individuals in the general public to corporates to governments. And, actions like President Trump reversing out of the Paris Agreement are extremely unhelpful. And it's clear that we do need to accelerate. And the way to do that, we would argue, and I think a lot of the panel would probably agree, is we've got to engage across all sectors. We need every corporate that we talk to and invest in and could potentially invest in to think about this, think about what they can do, what initiatives they can invest in, how they can support the proliferation of renewables, how they can be more energy efficient in their operations, how they can use resources more effectively, recycle everything. We need them to consider all of this, whether they're a pharmaceutical company or an airline or a mining company or an energy company. It needs to be across the entire spectrum and across all markets and all regions of the world. But obviously, as population grows, as economies grow, there is a huge challenge to do that while also addressing the problem that we face with climate change. But in terms of investments, in terms of what we can do, you know, to Miguel's point, we have a very loud voice with the C-suite, and we can enact real change if we make the effort to do so. And I think that's what we have to do.
If I may add to what Mike was just saying, yes, I 100% agree to everything, but there's also a role for the consumer, and especially for the consumer that has had the luxury of accessing education and being fed as a child, so has a brain that's working. There's the voice of the investors is very loud, but so is the voice of millions of consumers that vote with their pocket every day. So it's up to us also to start demanding this different kind of products, or at least asking the questions which we not always do. And this is not something that we can expect very, very low income countries to do. It has to be done from the countries that have the time and the energy to start fighting for that. But yeah, and again, I think that the enforcement of regulation is key. Many times regulation is passed, but then it's not enforced properly. And I see that a lot in emerging markets, and hence why also the agenda doesn't progress.
And maybe not just, again, it is not just consumer, but again, different kinds of asset owners. So it's not the retail investor we're talking about. So in Latin America, there are a lot of family offices. There are a lot of billionaires. So there is a lot of wealth. So I think it's key that, again, all these asset owners are activated. So Pablo, you wanted to.
So I wanted to add to that. There is public support and regulation obviously help, but if we want to change things, it's not going to come. It's going to come from the public sector. It has to come from us, for private agents, from consumers, from asset owners, from investors, from executives, and bringing that change of mindset where we incorporate what we do. It forms part of the solution of the problem and include the impact in the decisions that we make. If we go to this deeper sense of value in the things that we do, it's the only way that we think we will start to change things. Right? We will start to change the way we consume, the way we behave professionally, or the way we invest. And that has a real capacity to move things more and beyond whatever regulation or public policy can do.
Just wanted to add, I mean, I think whoever asked that question is spot on. I mean, we as a firm are very frustrated about how long it's taking, and it speaks to the lags that are involved. If we're lucky, emissions are going to fall by about 5% this year, but we need basically 20 of those years back to back. So we need kind of 20 COVID emission years, back to back to get to the Paris goals. Now, investors, are very important. They typically sometimes only affect part of the complex. So if you think about oil and gas, the proportion of oil and gas extraction which is listed is actually the minority. There are a lot of state-owned enterprises. So clearly all stakeholders have to work together. But I think what shareholders are doing that's most powerful, the single most powerful thing, is to get companies to commit to science-based targets. So this is basically directly aligning the company with the Paris goals. And, there's companies that are setting very aggressive goals. Microsoft, for instance, wants to be carbon negative starting pretty soon. Other companies are taking longer. But getting companies to commit to science-based targets is the single most important thing that shareholders can do.
Thank you very much. And we are right on time. So I really enjoyed the panel. Thank you so much, everybody, for participating. I've learned a lot, and I hope, I'm sorry we did not address all the questions that were raised, but I hope that the audience also learn and it will engage more with different forms of ESG investing and see what role they can play in fighting climate change. Thank you very much. Thank you.